That is the close of bell on Wall Street, and now it is market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's trade. Let's see where the major averages ended up here. It was another volatile session on Wall Street. The Dow basically finishes flat here. We're down about 30 points. The S&P 500, your broad gauge, it battles back, claws back into positive territory, finishes up around 0.4%. And your tech-heavy NASDAQ takes the gold. It finishes up about 0.9%. Of course, this is all coming ahead as investors hope for more specifics, more details, maybe more clarity from President Trump, who is, of course, expected to announce those reciprocal tariffs tomorrow. Now over to Jared for a closer look at today's sector action. Jared.
Thank you, Josh. We got a little bit of a mixed market here. Dow kind of flat, as you said. But interestingly, in the NASDAQ and the S&P 500, we have a bull trap. That's a technical configuration that has happened over the last 2 days. I'm going to be breaking that down with Josh in about 30 minutes. But let's go through the indices here. S&P 500 also looking at some gains. But I did want to track the VIX. The VIX has come down just a little bit, still hovering above 20. It's at 22 right now. You can see that on your screen. And the 10-year T-note had a pretty big drop today, 9 basis points to basically the lowest point, or very close to the lowest point of the year. So interesting development there to watch, especially as we head into some more economic heavily periods with respect to the markets. Now, if you take a look at the sectors today, healthcare was down 1.8%, by far and away the biggest loser. Financial slightly in the red, but consumer discretionary and tech had nice days, up 1% and about 0.75%, respectively. Energy and industrials also outperformers. And let's take a look at the NASDAQ 100. You can see a lot of love for the mega caps there. Tesla up 3.5%. Meta, Alphabet, Amazon, Nvidia, and Microsoft all up more than 1%. So some nice green there. And if we take a peek at the Dow, we can also see green, a little bit of red there. Visa down 1%. United Health down just a little bit. Disney down 1%. For the most part, a pretty broad-based risk on day. And just rounding things out with some of the leaders here, weakness in biotech. I did say healthcare was leading the way down, so these two biotech ETFs are biggest losers here. Regional banks, KRE, that's also in the mix to the downside. Value stocks not doing that great. But Bitcoin, GBTC up 3%, and also the Mag 7. So some of the larger issues plus crypto, which is interesting. And I'll finish on Bitcoin. Bitcoin up 3.06% over the last 24 hours to just short of $85,000.
Thank you, Jared. For more on the latest market moves as the countdown to Trump's tariffs is on, let's welcome in here Jim Beam, TD Private Client Wealth President. Jim, great to see you. So listen, we're 1 day out, Jim. It's Liberation Day. President Trump expected to come out, right, announce these reciprocal tariffs. I'm interested, Jim. What do you expect to hear, Jim? And what's it going to mean for the markets?
Yeah, first, thanks for having me. Really appreciate it. You know, I think we've seen tariffs in the headlines for the last several months. The markets obviously responded positively right after the election. All of a sudden, we get to March, total risk off trade, and I think that's based on the uncertainty around the whole thing. Look, I think that, you know, when it comes to the reciprocal tariffs, there's an opportunity for that to really, really impact the economy. I think that there's exposure for inflation to increase. I think we heard it on your show a little bit earlier today, the potential prices for cars going up, both new and used, a potential 1/4 point hit to PCE inflation. So big impact. I think tomorrow, though, what we've seen in March is obviously a reaction to the uncertainty. But you think about tomorrow is the beginning of probably finding out some certainty around the issue, which actually should be a positive thing going forward. I don't think it's going to be wrapped up tomorrow or in the next week, but it's going to take a little time here to wash through the system for sure.
Jim, it's Al Root here. We hear that it'll still take a little while to work out all the effects. How are you shepherding your clients through this uncertainty? What sort of changes are you advising? Hey, wait a second, maybe you don't want to be too rash here, and how you sort of just calming them down these days?
Yeah, Al, it's really what we do best, right? It's remove the emotional element from the investment decision making. Tough month in March, right? Off the heels of some really strong few years in a row of double-digit market performance. For us, it's about being diversified, buying high quality investments. We're constructive on risk assets going forward for the next 12 to 18 months. We think that the earnings will be there to support it. And what we're seeing right now is really, it's headline news. We're not investing for tomorrow. We're investing for the next 10 to 15 years. So we encourage our customers to have a plan, match an investment strategy to that, stay diversified, and invest for the long term, because ultimately that goal to retire is there, right?
Jim, we were talking earlier in the show today to a strategist, smart guy. He recently cut his target for the SPX to 5,900. But we were asking what he still likes, and he brought up big tech very quickly. And his reasons were, listen, he thinks, no surprise, thinks valuation looks a bit more compelling now. And he, by his estimates, he thinks earnings growth looks attractive. I'm just curious, when you think about big tech, Jim, your thoughts?
Yeah, look, it's probably a bit oversold at the moment. Obviously, the AI trade unwinding a bit here recently. So we're constructive on tech. I would say this too, when we think about sectors and you think about times of uncertainty, look, the energy sector has done really well year to date. And in some regards, last year, utilities were white hot and they're interconnected. So you think about rising global demand and limited supply could keep oil profits high and prices high. And you couple that with actually building the infrastructure to deliver on what's happening with AI and the high energy computing needs. Utilities have done really well, also, and look, it's it's a defensive play. So while we're constructive on risk assets, obviously tech's a big part of that, and will certainly be a big part of it into the future. I think there's some short-term opportunity there to take some yield.
Is there any sectors, and again, I understand completely your earlier comments and at the margin, but are there any sectors you're a little more worried about? Tech is defensive, good opportunity. What are some of the things you may want to avoid at the margin?
Yeah, look, I don't want to say avoid, but I am concerned about the consumer, right? We hear about the potential spending becoming an issue. Obviously, some of the money that's been in the system is coming out. So, as we navigate that, I think it's going to be really important to see how the consumer reacts. So, obviously, the sectors that are directly attached to that are a concern right now.
Okay, something totally different. If we stop talking about tariffs for 1 second, what are you sort of most worried about, or what do you think we should start thinking about in the second half of the year?
Yeah, it's another great question. I think, look, the geopolitical uncertainty, tariff is grabbing the headlines, but we still have, when you think about the global trade war, and that obviously being a big issue, the geopolitical uncertainty has to come into play. That impacts supply chains. You think about that bleeding through to earnings, jobs, Fed policy. So it's very much interconnected. And while certainly maybe not in the news every single day like the tariffs, it's something to certainly keep an eye on as we embark through 2025.
Jim, great to have you on the show today. Thanks so much for your time.
Thank you.
Stick around, much more market domination overtime. That's coming right up. President Trump's highly anticipated rollout of sweeping new reciprocal tariffs is drawing near. The administration reportedly considering a 20% broad tariff on all imports. It's according to Wall Street Journal. Here with a tariff analysis of the potential impacts to the economy and the consumer, we've got Ernie Tedeschi, Director of Economics at the Budget Lab at Yale. Ernie, it is great to see you. So tomorrow, President Trump, tariffs, Ernie, what are we going to hear? Your guest, Ernie, it's as good as mine. But let's do this. So you modeled the effect of 20% broad tariffs, Ernie. You crunched the numbers. Walk us through it. What did you find?
Yeah, so a 20% broad tariff is a $3.1 to $4.1 trillion tax increase, depending on how much retaliation there is. For the average household, that's between $3,400 to $4,200 in burden per year. So think of that as the average hit that they take. It's going to increase prices by between 2 and 2.5%, assuming the Fed doesn't react to that, which is what they said that they wouldn't do. And in the short run, I would shade about a point off of GDP growth. as a result of that. And remember, that's just the 20% broad tariff. That doesn't count what they've already done this year in terms of China, Canada, and Mexico tariffs. So we still have to see how whatever they announce tomorrow stacks or interacts with what they've already implemented so far this year.
Ernie, it's Al Root. Can you walk us through, there's lots of, it's a one-time rebasing of GDP and then we grow off that base. Can you sort of turn it into consumer terms? Like, do I see the $3,000 sort of immediately as it spread out over a couple of years and I barely notice and, we manufacture things here and it's all wonderful. How do you think it sort of plays out practically for regular old Americans?
Yeah, it's a great question. So I think for perishable goods, things like fresh produce, you're going to see those price increases relatively quickly at the grocery store. Particularly if what they announce tomorrow hits countries where we import a lot of agriculture, like Mexico, for example. For durable goods, things like electronics, large appliances, automobiles, that takes a little bit longer, like on the order of a few months, because retailers will work through the inventory that they already have in stock first before they move on to the tariffed inventory. And so consumers have a little bit of a grace period before they see prices there start rising. But even there, we're talking about a matter of months, not years. And so when I say like 2 to 2.5% increase in the price level, that's in the short run. That's within the next year that consumers are going to feel that pain.
Ernie, I'm just curious to get your take on what Trump's strategy is here. When you listen to the president and when you listen to those in his administration, it sounds like, broad strokes, Ernie, what they're trying to accomplish is, listen, we want to reorder just the global trade system. We want to put American companies on what we would consider fairer, stronger, more competitive ground. We don't think the current system of tariff rates makes sense in April 2025. Why is the U.S., you'll hear them say, why, Ernie, is the U.S., we impose a 2.5% tariff on auto imports from Europe. They hit back, they impose a 10% duty on us. That's just tariffs. There are all these material non-tariff barriers, right? China stealing our IP. So that's what they say they're trying to remedy, Ernie. What's your response to that as an economist?
So I guess two things. Number one, if indeed what they're announcing tomorrow is a 20% broad tariff across the board on all countries, that's not really reciprocal anymore, right? Like, that's a very blunt instrument that isn't surgically or custom tailored to, different issues of fairness between different countries and different relationships that we have. The second thing I would say is that their strategy is for the United States to do more things on our own. And I think that there is justification in some instances for doing that, especially on things like national security grounds. We want to have more manufacturing capacity so that we can have more shipbuilding capacity for military purposes, critical minerals capacity, for example. I think in those cases, tariffs that allow that to build up over time can make a lot of sense. But those are very narrow cases. That doesn't justify a broad, large 20% tariff that brings us back to tariff rates, in the late 1800s and early 1900s. At the end of the day, if the United States tries to do too many things, including things where it doesn't do things well, our economy is going to end up smaller as a result of that. And our productive capacity is going to be less over time. And that's exactly what our modeling shows.
Without getting too far over my political skis, sort of like every problem is a tariff problem. We have one tool in the administration. You talk about some of those interesting national security grounds. What are a couple of the other types of policies that might make sense to sort of accomplish the same thing without sort of putting the fear of God into every investor?
I mean, look at what China did with electric cars, right? So they allowed Tesla to invest in China, but the government took a stake in Tesla when they opened up in China, and made Tesla share IP with them. The United States could have a similar relationship with BYD here, and take advantage of the low cost technology that Chinese electric vehicles have. Right, that's a non-tariff way of being able to both open up markets to good products, but also give an advantage to American companies at the same time.
Ernie, it's always great to see you and have you on the show. Thank you, sir.
Amazing. Thanks for having me.
Ongoing cargo front loading as a hedge against tariffs led the Port of Los Angeles to its second best February on record. Despite that strong start to the year, though, our next guest anticipates volumes to soften at some point, particularly with respect to larger imports like furniture and appliances. Joining us now is Gene Soroka, Port of Los Angeles Executive Director. Gene, it's great to see you. So as I think you can imagine, Gene, listen, we've been talking a lot today about the big day tomorrow, Trump, reciprocal tariffs. You have a unique line of sight here, Gene, because I'd imagine you're talking to a lot of different folks from a lot of different sectors, Gene. You know, you're talking to importers and shippers and retailers and manufacturers. What have been the big takeaways from those conversations, Gene? What are they saying about all this?
Well, good afternoon, Josh. Good to be back. And what most importers of the larger segment have been telling me since the campaign trail last summer is they're not going to dismiss anything that this administration would have to say. So they started inching up and bringing in cargo a little bit earlier than normal or advancing inventories in the plan that if tariffs were implemented, they could average their costs down. Now, we've got about 125,000 companies that import through the Port of Los Angeles on an annual basis, and no one has more than a 5% share. So while some of the big box retailers bringing in finished goods and possibly some of the manufacturing inputs coming in could be advanced, it's the small to middle-sized retailer that may not have had the capability of doing that, whether it be warehousing space, fronting the money, or being able to position themselves in the market. Those are the folks that we're watching very closely right now.
Gene, it's Al Root here. I'm just curious, how did Q1 sort of turn out at the port? There's this rush, followed by this, there's going to be a volume cliff. What was the reality, and what do you see for the next couple of months?
Al, good to see you again. What we saw was about 7 straight months in excess of 900,000 container units coming into the Port of Los Angeles. And realistically, that's a peak season month every month during this time of advanced inventories. The first quarter will be one of our best on record. And what I've said is that probably second half of this year, we'll see about a 10% decline in cargo volume because you've brought in just about all the product you can at this juncture and still keep your supply chain fluid. We've got a little bit of experience, although on a smaller level, back in 2018 when Section 232 and 301 tariffs went into place. And at the end of 2019, that fourth quarter, saw our business drop by 16%. So there will be peaks and valleys through this continued uncertainty of start and stop points.
For those unaware, Gene, the uninitiated, your port complex, Port of Los Angeles there, just walk us through how big and important is that port, Gene?
Combined with our neighbors in the Port of Long Beach, the ports of LA and Long Beach combined account for 40% of our nation's imports and about a third of our exports. The cargo that moves through the Port of Los Angeles not only reaches every one of our 50 states, but all 435 congressional districts.
And that import-export balance, if you look out in terms of policy and policy development, how do you guys plan for shifts in sort of the long-term trend of imports versus long-term trend of exports? Are you sort of neutral? You just want to see activity, or are you worried about one taking over for the other?
Well, Al, our primary job here is one of a real estate company, leasing long-term permits out to those who push trade through our gateways, liner shipping companies, third-party logistics, terminal operating companies. The balance of trade in the United States from a container perspective is about 5 to 2 nationwide, and it's about 5 to 1. 5 imports for every 1 export going out of the Port of Los Angeles. And I think this presents our country with a unique opportunity as we go through new trade policy, tariffs, working on bilateral agreements. There's a real opportunity here to show the world what American exports can do and amp up the volume there.
Gene, final question here. We have to wait and see the impact on China from these tariff hikes. But the Journal notes China's exports performance over the first 2 months of the year weaker than expected. I'm just curious, what has all that meant for your port, Gene?
Well, it's been interesting, Josh, since the first tariffs went into place back in 18 and through now, we've been able to grow our business at the Port of Los Angeles while the China component has decreased. In fact, at its highest point, China represented about 57% of our portfolio. Now it's just shy of 45%. And last year in 2024, we grew at about 20%. So we've been chasing the cargo. Our liner shipping companies have been putting in nonstop services to get cargo to market faster because that speed component has always been our value in the go-to-market strategy. There'll be more of that to come in the future now with these additional tariffs.
Gene, always great to see you. Appreciate your time and insight, sir. Time now for what to watch Wednesday, April 2nd. We're going to start off on the tariff front, of course. We're on the eve of President Trump's so-called Liberation Day. The Trump administration planning to implement reciprocal tariffs, targeting countries to match the duties that they charge on U.S. products. Checking in on Boeing, CEO Kelly Ortberg is planning on telling the Senate Commerce Committee that the company is working on overhauling its quality standards and culture. That's according to Bloomberg. It would be the first time Ortberg is appearing before U.S. lawmakers since he became Boeing's CEO back in August. And taking a look at the Fed, we're going to get some more Fed commentary tomorrow from Fed Governor Adriana Kugler. This is coming after comments from New York Fed President John Williams yesterday. Williams telling Yahoo Finance that rates will remain steady for, quote, some time amid uncertainty from President Trump's tariffs. And finally, some more companies reporting, including RH and BlackBerry. RH is going to be announcing results for the fourth quarter and fiscal year 24. That's after the markets close. And expecting the company's sales growth to pick up, driven by strong demand for their brand and positive signs from competitor Williams-Sonoma, which also reported better furniture sales. Well, that'll do it for today's Market Domination Overtime. Big thanks to Al Root for hanging out with me today. Al, it was great to have you here.
So much fun.
You know, and it was funny because we talked markets and tariffs and ports. I actually really could have just talked about cars.
We just should have talked about trucks.
For an hour. Yep. Just trucks specifically. Let's do that next time. 90 minutes of just trucks. Al, thank you. Be sure to come back tomorrow, 3 p.m. Eastern, for all of your coverage leading up to and after closing bell. And on the other side of the break is Asking for a Trend. I've got you covered for the next half hour. The latest and greatest market move stories so you can get ahead of the themes affecting your money. Stay tuned.